making choices for diversification, asset allocation, and risk tolerance. Stocks, bonds, mutual funds, and commodities offer diverse opportunities for financial gains and involve different risk as well. In striking the right balance for risk among investment alternatives, financial managers seldom take an extreme approach. They seldom take an extreme approach. Total risk and total risk avoidance. In selecting their investment, extreme positions attract extreme results, and most investors have a preference towards either risk or risk avoidance, but they are not totally immersed at either end of the risk spectrum. Instead, they select a mixture or portfolio of investments, some riskier and some more conservative, that collectively provides the level of risk and financial stability at which they are comfortable. They do this in two ways through diversification and asset allocation. Let's talk about both of them one by one in detail. Diversification. Diversification means buying several different kinds of investment rather than just one. For example, diversification as applied to the common stock means that you invest in stocks of several different companies such as IBM, Cisco, Cisco Systems, Boeing. Rather than put all your money in just one single company, you diversify it. The risk of loss is reduced by spreading the total investment across most stocks because while any one stock may tumble, chances are less that all of them will fall. Even more diversification is gained when funds are spread across more kinds of investment alternatives, say, for instance, in stocks, in bonds, in mutual funds, in real estate, and so on. Among the tragedies resulting from the scandals of real estate and so on, if we talk about the tragedies resulting from the scandals, and if we mention Enron and WorldCom, were the lifelong employees who did not diversify their investments and instead had all of their retirement funds invested in their firm's stock. This was an extremely risky position, as they sorrowfully learned that that was the wrong decision. When their firm's stock took a free fall to near zero, their retirement funds disappeared. Asset allocation. Asset allocation is the proportion, the relative amount of the funds invested in for allocated to each of the investment alternatives. You may decide, for example, to allocate $200,000, sorry, I beg your pardon, please, $20,000 to common stocks and $10,000 to a money market mutual fund and $10,000 to a US Treasury bond mutual fund. 10 years later, you may decide on a less risky asset allocation of $10,000, $15,000, and $15,000 in the same investment categories, respectively. In this example, as investment objectives change from moderate risk to a lower risk for capital preservation, the asset allocation must be changed accordingly. This is one way of doing the business, not to throw everything in a single field or single organization. We diversify and then we allocate the assets accordingly as well. As we allocate the assets accordingly, we do adopt to a policy of preservation. Buying and selling securities. The process of buying and selling securities is a complex one. First, you must find uh, about the possible investment and match them to your own investment objectives. Then you must select a broker and open an account. Only then you can place an order and make different types of transactions. Financial information system. Have you ever looked at the financial section of your daily newspaper? And have you ever considered what all those tables and numbers means? It is a good idea to know how to read stocks, bonds, and mutual fund quotations if you want to invest in issues like that. Fortunately, this skill is mastered only by going through the newspapers, the reports, and then financial understanding.